Hey, what's up, guys? This is Cree coming to you from Austin, Texas. And today's video, we're going to be talking about how does velocity banking work, and does it really work? And how does velocity banking work again? Today's video, I really wanted to go dive deeper into showing you how velocity banking actually works. It's kind of a difficult concept to understand. A lot of times people think that they can just make double payments, and making double payments will actually save them the same amount of money as velocity banking will, and in reality, it really won't. But your situation could be completely different than somebody else's. I have a friend that has a business that generates over $75,000 a month, and he's not in the same situation as someone that's making, say, $7,000 a month. Totally different scenarios. He actually has debt on his house. The person that makes $7,000 a month may also have debt on their house, but may not have a business that generates excess cash flow. So each person's scenario is different. And what you have to understand is that when you're looking at possibly doing velocity banking, you really need to calculate how much interest you're going to be saving before you start doing it, and what kind of debt instrument you're going to use to carry the debt over from your higher interest rate debt. So, for example, you may be in a 30-year fixed rate amortized mortgage, but you might be in year 25, and you're not going to save any interest if you go with a 25% interest credit card, right? However, you might be in the reverse. You might be in year number 2 of a 30-year AM, and you're paying at 6% interest rate, and you have a credit card with, say, a 4% interest rate. You're going to save a lot more money by doing the 4% interest rate card and doing chunking than if you just make the payments on your 30-year AM. So each person is different. Your situation is different than this example, and you need to understand that. You need to understand how the tools work, how to calculate your interest, how to calculate your savings, and also understand the different instruments that are out there. There's a plethora of them. You can use lines of credit, personal loans, personal credit cards, personal lines of credit. You can also use HELOCs, home equity lines of credit. You can use, well, PLOC is a personal line of credit. You can also use personal money, private money that you raise from your friends and family. You can use your life insurance policy. You can use a 401k. You can do a self-directed 401k and lend money out of your self-directed to yourself to pay off a higher interest rate debt. So the possibilities are almost endless, but take a moment, watch this video. If you have questions, comment down below. I will do my best to answer them, and if it requires another video, I will do another video to answer that question as well. Thanks, guys, for watching. Check this out. All right, so this is mortgagecalculator.org. It's a free website. You can go check it out. But basically, you come in here. This is a simple amortized interest calculator. And so if you come here to the home value, plug in, say, 400,000 if you live in Austin, 500,000 if you live here, or you can go out to like Killeen, Texas. You can go pretty much in like suburbs of major metropolitans. You can still find like $200,000, $300,000 houses. But essentially, most people don't put down 20%. So they're going to be looking at something like around first-time home buyers, 3.5%. By the time you're done with it, closing costs and everything, 5%. So you're essentially putting down $10,000 on a $200,000 purchase. With rates the way they're going, call it 6.25, right? 30-year term, you're going to have PMI of 0.5%. Home insurance, right? Conventional financing, or actually we'll do FHA. And then buy, calculate, and this is going to be what your payment looks like, right? $1,500 a month in interest. In total payment each month. That's going to include your interest, your principal, and your taxes, right? So if you look at the interest versus principal payment, the total payment is $1,532. That's per month. If you take the interest right here, $11,729, if you're paying $11,729 in the first 1, 2, 3, 4, 5 years, right? It kind of flatlines. It's going to be about the same the first 5 years. This is right about where people mostly refinance because they're like, oh, rates went down. Let me go ahead and refinance. I'll save money, right? Well, you don't actually save money because you kind of get stuck in this interest front-loaded payment section. So we're at $11,729 divided by 12 is $977, right? You're going to have to pay another $435 in taxes, right? So about $1,000 of that payment is going to be $2,300 divided by 12. Yeah, about $191. So we're looking at $191. Let's just go ahead and do 4,350 plus 11,729 plus 2,308 divided by 12 puts us at 1,532. So if we subtract the taxes and the interest, that's a $1,339 is how much you're paying towards interest and taxes. That's it, right? You're going to have taxes anyways if you did a HELOC as well, but your interest payment the first 5 years, let's do that math, right? 11,729 divided by 12 divided by 1532. That's a 63% interest that you're paying right there for those first 5 years. So essentially what velocity banking does is you're taking this chunk right here and you're bringing it to the front. It's a conceptual thing. It's kind of difficult to understand. A lot of people argue that just making double payments will do the same thing, but when you actually run it through a calculator, we did this from my mom's house, and I was trying to show her it's math, Mom. Like, it's math. Like, it's not an opinion, it's math. And what we found is that using velocity banking and just a credit card, a 20% credit card, she would be able to save about 3 years off of her payments and around $30,000. This is on a $500,000 house. $30,000 in interest in 3 years would shorten on the payoff period just by doing this method. So the reason it works is because, yes, as you're making the payments, your interest goes down, but what happens is your interest payment is not spread out. Your interest rate is not spread out over the entire length of the loan. Your interest rate is based off of a simple daily interest calculation. And so without getting too far in the concept, because I would actually have to start modeling it in order to really remember how to best explain it, the concept here is that our interest payments on this interest rate are $977. If we take the same amount, the same dollar amount, and we say, okay, it's $200 or $200,000, and we're putting down 90%, or we're putting down 10%. So that means that's how much interest we have to. That's how much of the that's the right number of zeros. That's how much of the funding amount that we need to calculate the interest on, if that makes sense. So we're going to take this and we're going to multiply by 5%. So this is how much we pay per year. This is how much our monthly payment is. That versus that, right? You save $227 a month. What does that do for your cash flow? Well, if you're making the same payment, then multiply that by 12. You're making additional payments of $27.24 just by simply using the HELOC over the fixed rate amortization schedule, right? And the reason why this 30-year the 30-year amortized loan is not as favorable as, say, like a 15-year amortized loan is that you're paying so much more in interest because you're lengthening the loan. Lenders have to be able to collect interest on their money. And the more risk they're going to take, which is they're giving you the money for 30 years, right? They're expecting you to pay it back over 30 years. They're risking their capital for 30 years. If they risk it for 15 years or 10 years or let's say 5 years, they're going to get a lot higher interest on their money, but they're going to get their money back faster, right? Actually, I would say that in a different way. They will likely do a lot lower interest rate, but it's going to be a lot higher payment, right? So then you have this kind of, you're playing with payments. So your payment gets higher the shorter your length of your loan. The longer you spread it out, the lower your payment is, which is what most people look at, but they don't actually look at the tax or the cost savings in terms of the interest payment, right? So if you can afford to do a shorter loan, like you can just go ahead and do a shorter loan. If it's your primary residence, though, this strategy is so useful because unlike a 30-year fixed rate mortgage where you can only access it at this point and at this point, or when you refi and you're going to have to start back over here again and start playing the interest game, if you refi every 10 years, you're essentially paying all of this interest and this much principal, right? When you use a HELOC, every time you're making interest payment, it will be, your interest payment will just be shorter, right? It'll look more like this because you're paying essentially similar interest, but this dark blue line is going to curve up faster. Best way I can put it. I don't know if they actually have a calculator on here that does the HELOCs. Yeah, here you go, HELOC. So let me see if I can zoom out a little bit. So come in here, let's say we want to do a loan term of, let's do 15 years. Closing costs. We've got a closing cost, we've got interest rate. We're going to use a 6.25% interest rate. And then we got federal income tax rate. Yeah, that's fine. Understanding income tax implications. So you want to obviously read that. You don't want to just take advice from YouTube and then find yourself in a tax liability. I'm not a lawyer. This is not tax advice, not legal advice. This is not financial planning advice. And we're going to say we've got all these different debts. I'm just going to leave this alone, basically. And we'll calculate total debt, 19 grand, HELOC, monthly payment. Okay, cool. Now let's go back to, I want to just like clear all this out and just say, we've got I wish that this would calculate based off of a home. This is not really the best version. So what I would do is I would go to first lien. This calculator is actually built just for this. So you can go to first lien HELOC calculator. So you've got, let's say, a $200,000 house. And amount to be refinanced is going to be $180. Loan term, 30-year, fixed rate, 5%. I'm actually going to bump it up to 6% because we're going in that direction. And this is fine. I actually got a better credit score than that. Primary residence. Next. Cash flow, let's just call it $5,000 because, I mean, let's be real. Average American, $5,000 sounds reasonable. It's like dual income household, $5,000. Some people make way more than that. Others make way less. Monthly expenses, let's call it $2,400 a month. That actually, I think that's a little bit high. I think it's got to be like $2,200. Yeah, because it's got to stay under 40%, 45% debt to income ratio. Yep. Next. There you go. Boom. So based on what you filled out, you could be paying it off in 10.58 years. Our calculations, so you're not a good fit. Interesting. You could save $157,000 of the total cost of your home, paid off how much sooner? 19.42 years. Wait, not a good fit? Interesting. Total cost paid in interest. So essentially, you're paying $388,000 for a $200,000 house with the fixed rate mortgage example, and if you do a first lien HELOC, you're paying $231,000, a difference of almost $150,000. So pretty significant, right? And all you're doing is you're just simply shifting the debt from a fixed rate mortgage over into a HELOC. Now you might be like a little bit concerned because what if the HELOC rate adjusts? Well, let's say what if it goes up to 20%, right? If you're borrowing, let's say $180,000. Because that's what you're doing is you're borrowing it to pay off your mortgage with the other bank, and you're having to pay 20%. You're paying $3,000 a month. That could hurt your cash flow. So that would be a good idea to lock in that rate. They're actually, First Lien HELOC is actually talking about locking in the rate for your HELOC for 3 to 5 years so we can kind of weather the storm. Pretty cool, huh? So rather than having to pay that mortgage payment of, I want to say it was like $1,500 or something, we're going to put down 5%. And actually, to make this totally fair, we're going to go back to the First Lien HELOC calculator. We're going to say we're going to finance $200,000. We're going to do $190. Term 30-year, interest rate. So it should pull up in just a minute. So, oh man, I'd only saved $93,000. Shucks. Paid it off in 17.5 years sooner. Shoot. Okay, well, so my total cost to buy the house is $273,718. Total interest paid is $83,000. Over here, my interest is still double. A little bit more than double. So it's a really useful tool when you understand it. Also understand too, if we hit a 20% interest rate market, like we've very rarely ever hit a 20% interest rate market. Interest So here it's about 7, rising up to 12.9. It was as high as 18.45 and 18% interest rate in the 90s, back down to 6.5, 6 to 5, 18% in 1981, and let's see, 8.5, 3.4. So basically, this is the peak of like average rate in 1981 was 16.64, and then it just drops all the way down here to like 2.96. So it's like, if the rates are that low, if prime rate got down to like literally a half a point or a quarter point, why would you even bother with a long-term, like a fixed rate 30-year mortgage when you can pay off your house, your primary residence, in like 6 years, 7 years? If you're really just throwing all your money into the HELOC, you could just knock it all out, right? Then the question is like, well, what do you do with that huge chunk of money that's just sitting in your equity in your home? Dave Ramsey would say, don't touch it, right? Just leave it alone. Keep, save, invest, and give. I'm all for donating money and helping other people and stuff, but there are better ways, because if you learn how leverage works, you can actually use leverage to your advantage. Where having a fixed rate, like a 30 or 15-year fixed rate, 15 is really the ideal. If you've got enough liquidity to be able to buy a rental property with a 15-year fixed interest rate mortgage, you're going to pay a lot less in interest. This is how a 15-year interest payment looks, right? We're going to get rid of this guy. PMI goes, PMI stays. We're going to do a conventional. We're going to do a buy, calculate. So my payment's still fairly high. However, same amount of money down. I'm doing a 15-year, and look at the interest I pay. My interest is literally almost 50%. So I save myself a huge chunk of money early on, right? I have it paid off in 15 years. After that, I'm getting cash flow, and here I'm paying majority principal in year, we're in 2022, year number 7, year number 4, it flips. I'm making mostly principal payments. Now again, this would be a great scenario where it's a rental property, where it's going to cash flow. Your primary residence, getting a 15-year fixed is not necessarily the best strategy, because again, you're putting a lot of money into interest when you could be paying a lot less in interest with this strategy, right? For your primary residence, you got to live somewhere, right? With this strategy, it's really great if you're going to be picking up like a portfolio of rentals, or you're going to be just adding rentals every couple of years, and you've got cash flow from the previous rentals. You can use as a down payment. You can also do a 30-year fixed if you want more cash flow. Then you can go out and buy more properties faster. But there's kind of an inverse equation or inverse relationship where you have more leverage, you have a little bit more risk. But if you have more leverage, you have a lot more cash on cash return, which means you have more cash flow that you can then divert to buying more assets. The more you pay down those fixed rate mortgages, the more cash flow you have, right? So you pay off the first one, second one, third one, fourth one. Now you've got 4 units of production that are paying, or that are cash flowing with no mortgage. You use that cash flow to go ahead and buy another property, and another one, and another one, and another one. And then you go buy bigger properties, right? And that's just the game we're playing. So these are different tools, not one's better than the other, but you have to understand how to use them.